our knowledge series on corporate tax in UAE. In this video you will learn about the tax grouping. This video covers the following important matters of tax group. Conditions application to form a tax group. Application to become a tax group. Changes to tax group membership. Cessation of a tax group. Business restructuring within tax group. Tax group responsibilities. Treatment as a single entity. Calculating taxable income for a tax group using the arm's length principle. Losses and tax group changes. Assets and liabilities transfers within tax group. Interest cap for tax groups. Introduction. According to Article 42 Clause 1 of the Corporate Tax Law, the tax group status offer eligible companies to consolidate their financial results, assets, and liabilities, eliminating transactions between them and treated as a single taxable person for corporate tax purposes. This limits their overall compliance requirements, simplifies the treatment of intercompany transactions, and minimizing their overall tax burden and cost. Eligible companies. Tax group rules relate only to companies, that is juridical persons, not to natural persons. Residents. As per Article 40 Clause 1 of the Corporate Tax Law, only resident juridical persons may form a tax group. According to Article 3 Clause 1 of Ministerial Decision No. 125 of 2023 on tax groups, a juridical person is a resident person if they cannot be considered resident for tax purposes in a foreign territory under a relevant international agreement in force in the UAE. Article 3 Clause 2 of Ministerial Decision No. 125 of 2023 mentions, where a member of a tax group becomes resident for tax purposes in a foreign territory, that member is treated as leaving the tax group from the beginning of the tax period in which it became a resident in such foreign territory. Article 3 Clause 3 of Ministerial Decision No. 125 of 2023 states, if a company is incorporated outside of the UAE but is considered resident in the UAE because it is effectively managed and controlled from the UAE, it must maintain evidence that it is not resident for tax purposes in that foreign territory. Under Article 3 Clause 4 of Ministerial Decision No. 125 of 2023, acceptable evidence is either a confirmation issued by the relevant tax authority of that foreign territory, or a confirmation issued by the relevant competent authorities for the purposes of the application of the relevant international agreement in force in the UAE. Ownership. The requirement of ownership is at least 95% direct or indirect, effective holding by parent company and subsidiary. Under Article 40 Clause 1b, c, and d of the Corporate Tax Law, for the ownership requirement to be fulfilled, at least 95% of all three of the following must be held: share capital, voting rights, and company's profits and net assets. As per Article 2 Clause 2 of Ministerial Decision No. 125 of 2023, share capital means the nominal issued and paid-up share capital, or membership or partnership capital of each subsidiary, as applicable. Article 9 of Ministerial Decision No. 125 of 2023 mentions, for the purposes of determining whether the 75% qualifying group threshold or 75% loss transfer threshold has been met, direct and indirect ownership interests held by members of the same tax group are determined based on the aggregation of the assets and liabilities of the parent company and each subsidiary. Taxable persons. Under Article 40 Clause 1e and f of the Corporate Tax Law, following companies are excluded from the eligibility to be a member of tax group: qualifying free zone persons, exempt persons. Subsidiaries of the aforementioned persons may also not be part of the tax group. However, if a qualifying free zone person makes an application to FTA to be subject to corporate tax, it loses its qualifying status, therefore it can be a member of a tax group. Accounting arrangements. Under Article 40 Clause 1g and h of the Corporate Tax Law, companies must meet the following requirements to form a tax group: same financial year and same accounting standards. This requirement ensures consistency when figures are consolidated. Further, income and expenses, as well as assets and liabilities, are matched to the same tax period. It also decreases the opportunity for figures to be manipulated, leading to abuse of the rules. Continuity. Article 2 Clause 1 of Ministerial Decision No. 125 of 2023 states, for a tax group to be formed or continue to exist, all of the aforementioned conditions must be met continuously throughout each relevant tax period. Government entities and tax groups. A government entity cannot be a member of a tax group being an exempt person. However, as per Article 40 Clause 2 of the Corporate Tax Law, subsidiaries in which a government entity directly or indirectly owns at least 95% ownership interest can themselves form a tax group, provided they are taxable persons, and they meet the other conditions, that is 95% ownership and any other conditions prescribed by the FTA. Application to become a tax group. According to Article 40 Clause 3 of the Corporate Tax Law and Article 5 Clause 1 of Ministerial Decision No. 125 of 2023, parent company and all subsidiaries wishing to form or join a tax group must apply to the FTA before the end of the tax period in which the formation or joining of a tax group is requested. As per Article 41 Clause 1 of the Corporate Tax Law, the formation of a new tax group becomes effective from the beginning of the tax period specified in the application, unless the FTA chooses a different date. This means that a company may only be part of one tax group for a specific tax period. Changes to tax group membership. Joining an existing tax group. Article 40 Clause 9 of the Corporate Tax Law mentions, parent company and the relevant subsidiary can apply to the FTA for joining of the subsidiary in existing tax group. As per Article 41 Clause 1 of the Corporate Tax Law, the addition of further members to the tax group becomes effective from the beginning of the tax period specified in the application, unless the FTA chooses a different date. According to Article 5 Clause 5 of Ministerial Decision No. 125 of 2023, a newly established company may join an existing tax group from the date of incorporation where that company is a newly created subsidiary or a newly created parent company that replaces the parent company of an existing tax group. Leaving a tax group. Article 40 Clause 10 of the Corporate Tax Law states, a subsidiary may leave a tax group either on application by the parent company and relevant subsidiary to the FTA, or where it is no longer eligible to be a member. Article 12 of Ministerial Decision No. 125 of 2023 mentions, when a subsidiary leaves a tax group as a result of no longer meeting the conditions to be a member, it must notify the FTA within 20 business days of the date the conditions are no longer met. According to Article 13 of Ministerial Decision No. 125 of 2023, when a company leaves a tax group, it must prepare its standalone financial statements on the same accounting basis as applied by the tax group and must adopt the values of the relevant assets and liabilities as recorded by the tax group as the opening values of those assets and liabilities in its standalone financial statements. Changing the parent company without discontinuation of the tax group. As per Article 40 Clause 12 of the Corporate Tax Law, the parent company can make an application to the FTA to be replaced by another parent company without the tax group ceasing. A change of parent company would become necessary if the original parent company ceases to exist and the new parent company or a subsidiary is its universal legal successor. Article 5 Clause 2 of Ministerial Decision No. 125 of 2023 states, where a parent company is replaced, the application to the FTA must be made before the end of the tax period in which the change is to take effect. Article 5 Clause 3 of Ministerial Decision No. 125 of 2023 mentions, the new parent company must meet all of the conditions to be a member of a tax group from the beginning of the tax period in which it becomes the new parent. Article 5 Clause 4 of Ministerial Decision No. 125 of 2023 states, where a parent company transfers its entire business to another member of the same tax group and the parent company ceases to exist as a result of this transfer, the parent company is replaced by that other member as of the date the transfer is effective. As per Article 5 Clause 5 of Ministerial Decision No. 125 of 2023, a newly established company may join an existing tax group from the date of incorporation where that company is a newly created parent company which is replacing the existing parent company. According to Article 40 Clause 13 of the Corporate Tax Law, the FTA also has power to change the parent company of a tax group, or to dissolve it, as it deems necessary. Business restructuring within tax group. Under Article 10 Clause 1 of Ministerial Decision No. 125 of 2023, where member of the tax group transfers its entire business to another member of the same tax group, and it ceases to exist as a result of that transfer, the ceasing member is deemed to remain a member of the tax group until the date it ceases to exist, and the tax group continues to exist. Or, tax group is comprised of only two members, and one member transfers its entire business to the other member, and it ceases to exist as a result of that transfer, the tax group shall cease to exist on the date that the transfer is effective. Article 10 Clause 2 of Ministerial Decision No. 125 of 2023 mentions, where a member of a tax group transfers its entire business or an independent part of its business to a newly established company, the new company joins the existing tax group from the date of its establishment. Therefore, the transfer is considered to have taken place within the tax group. Hence, for both above stated clauses, there is no requirement to make an election for business restructuring relief to apply as per Article 10 Clause 3 of Ministerial Decision No. 125 of 2023. Tax Group Responsibilities. Article 40 Clause 5 of the Corporate Tax Law states, the parent company of the tax group will be responsible for filing the tax returns, payment or refund of corporate tax and tax registration or deregistration. Article 40 Clause 6 and 7 of the Corporate Tax Law mentions, all members in a tax group are jointly and severally liable for corporate tax payments. However, it is possible to apply for liability to be restricted to one or more members of the tax group. Treatment as a single entity. Single taxable person. Article 1 of the Corporate Tax Law defines a tax group as two or more taxable persons that meet the conditions of Article 40 of the Corporate Tax Law to be treated as a single taxable person. As per Article 40 Clause 4 of the Corporate Tax Law, once a tax group is formed, all member companies are treated as a single entity for corporate tax purposes. Intragroup transactions. According to Article 42 Clause 1 of the Corporate Tax Law, intragroup transactions and transfer of assets and liabilities are eliminated in consolidation, therefore have no effect on corporate tax, since all group companies are treated as one. Article 4 Clause 1 of Ministerial Decision No. 125 of 2023 states, intragroup transactions are not eliminated insofar as a member has recognized a deductible loss in a tax period in respect of transactions that occurred prior to its joining the tax group or formation of the tax group, until the deductible loss is reversed in full. Article 4 Clause 2 of Ministerial Decision No. 125 of 2023 mentions, where a relevant transaction is not eliminated, the tax group must include any income in relation to that transaction in determining the taxable income of the group for the tax period in which that income arises up to the amount of the deductible loss that was previously deducted prior to joining or forming the tax group. Consolidated accounts. According to Article 42 Clause 1 and 11 of the Corporate Tax Law, the parent company must consolidate the financial accounts of all tax group companies for each tax period in accordance with accounting standards applied in UAE, that is IFRS. Advantages of a tax group. Treatment of all companies as a single taxable person can bring various advantages, such as filing a single tax return for all members of the tax group, simpler accounting for corporate tax, and the filing of a single tax return covering all members of the tax group. Transactions between members are generally ignored for corporate tax purposes. This will be particularly beneficial where the companies share centralized accounting systems, or where there are many intragroup transactions. Calculating taxable income for a tax group using the arm's length principle. Under Article 8 Clause 2 of Ministerial Decision No. 125 of 2023, in certain situations, each relevant member of tax group must calculate its taxable income using the arm's length principle, and disclose any information as may be required by notice or through a decision issued by the FTA regarding transactions and arrangements between the relevant members and other members of the tax group and between the relevant members and their related parties and connected persons. Under Article 8 Clause 1 of Ministerial Decision No. 125 of 2023, aforementioned clause apply where a member of the tax group has unutilized pre-grouping tax losses and net interest expenditure, earned income for which the tax group can claim a foreign tax credit. benefited from any corporate tax incentives for a qualifying business activity as specified in a decision issued by the Cabinet on the suggestion of the Minister under Article 20 Clause 2G of the Corporate Tax Law. Losses and tax group changes. Standalone loss generated by any one company shall belong to the tax group, which is used to decrease the tax group's consolidated profit. Losses when joining a tax group. According to Article 42 Clause 3 of the Corporate Tax Law, when a loss-making company joins a tax group, any unused loss it brings with it becomes a carried-forward loss of the tax group. However, this pre-grouping tax loss may only be used against taxable income of the joining company which incurred the loss and brought it into the group. Similarly, as per Article 42 Clause 4 of the Corporate Tax Law, the joining company's income cannot be reduced by the unutilized tax losses of the existing tax group. Aforementioned clauses related to pre-grouping tax loss and unutilized tax loss of existing tax group are subject to the tax loss limitation provisions mentioned in Articles 37 of Corporate Tax Law, that is, tax loss relief cannot exceed 75% of taxable income. Carried forward tax loss set off before any remainder can be carried forward or transferred. No relief for losses before commencement date of corporate tax law or prior to becoming a taxable person or loss incurred from exempt activity. And Article 39 of Corporate Tax Law, that is, ownership or business continuity requirements. These articles have been discussed in previous videos. Under Article 7 Clause 1 of Ministerial Decision No. 125 of 2023 on tax groups, the amount of pre-grouping tax loss of a subsidiary that can be used to offset the taxable income of the tax group in a tax period is the lower of taxable income of the tax group that is attributable to the subsidiary, 75% of taxable income of the tax group. Article 7 Clause 2 of Ministerial Decision No. 125 of 2023 states, pre-grouping tax losses must be used in priority to carried forward losses of the tax group. Article 7 Clause 3 of Ministerial Decision No. 125 of 2023 mentions, where there is more than one subsidiary with a pre-grouping tax loss, the group can decide which order to utilize the pre-grouping tax losses. As per Article 7 Clause 4 of Ministerial Decision No. 125 of 2023 on tax groups, pre-grouping tax losses must be used to the full extent possible in each subsequent tax period before any remaining amounts can be carried forward to the next tax period. Losses when leaving a tax group. Article 42 Clause 6 of the Corporate Tax Law states, when a subsidiary leaves a tax group, any unused losses of the tax group realized while it is a group member remains with the tax group. However, any pre-grouping loss of the leaving company will become a brought forward loss of that leaving company. Losses on cessation of a tax group. Under Article 42 Clause 7 and 8 of the Corporate Tax Law, where a tax group ceases to exist, unutilized losses are allocated as follows. If the parent company remains a taxable person, tax group losses stay with the parent. If the parent company ceases to be a taxable person, tax group losses are not available for offset against future taxable income of individual subsidiaries, with the exception of any unutilized pre-grouping tax losses of such subsidiaries, provided the subsidiary itself continues to be a taxable person. Another exception to this is where the parent company is replaced under Article 40 Clause 12 of the Corporate Tax Law. The unutilized tax losses will continue to be tax group losses. Assets and liabilities transfers within tax group. Intragroup transfer of assets and liabilities are eliminated in consolidation of group accounts. However, as per Article 42 Clause 9 and 10 of the Corporate Tax Law, where an asset or liability has been transferred between members of a tax group and either the transferor or transferee company leaves the tax group within 2 years of the transfer, any taxable gain or loss that would otherwise have arisen on the relevant transfer must be included in the taxable income of the tax group in the tax year the company leaves the group, and the resultant taxable income shall be taken into account on the date the company leaves the group, with the corresponding adjustment of the cost base of relevant asset or liability. This rule is to prevent a direct sale of an asset or liability being transformed into an indirect sale, that is through the partial sale of a subsidiary owning the asset or liability that would earn income from that asset and pay dividend to former parent company, which is exempt under the participation exemption. However, as per Article 11 Clause 1 of Ministerial Decision No. 125 of 2023, the transfer may still be eligible for relief under qualifying group or business restructuring reliefs. Assuming the transaction would have qualified, the parties to the transfer will be treated as if they had not been members of a tax group and had instead chosen to apply either qualifying group relief or business restructuring relief. Interest cap for tax groups. We have discussed in earlier videos that the amount of deductible net interest expenditure is subject to the interest cap. Joining and leaving a tax group. According to Article 12 Clause 1 of Ministerial Decision No. 126 of 2023 on the General Interest Deduction Limitation Rule, where a company with carried forward net interest expenditure joins an existing tax group, that carried forward balance can only be set off in future years against the taxable income of the tax group that is attributable to the joining company. Article 12 Clause 2 of Ministerial Decision No. 126 of 2023 states, where a company leaves a tax group, it can only take with it any carried forward net interest expenditure balance that remains from any balance it had when it joined the tax group. Any carried forward net interest expenditure that has arisen since it joined the tax group remains with the tax group. This means that the expenditure is matched to the profits of the same company, thereby preventing a tax group purchasing a taxable person with significant carried forward net interest expenditure balances to reduce tax liability of the tax group. Cessation of a tax group. Under Article 12 Clause 3 of Ministerial Decision No. 126 of 2023, where a tax group ceases to exist, any carried forward net interest expenditure balance is allocated as follows. If the parent company remains a taxable person, tax group carried forward net interest expenditure balances stay with the parent company. If the parent company ceases to be a taxable person, tax group carried forward net interest expenditure balances may not be used, with the exception of pre-grouping carried forward net interest expenditure balance of any subsidiary, which will take it on cessation of tax group, providing the subsidiary itself continues to be a taxable person. Another exception, as per Article 12 Clause 4 of Ministerial Decision No. 126 of 2023, is the replacement of a parent company under Article 40 Clause 12 of the Corporate Tax Law, which does not constitute the cessation of a tax group. Member of a tax group is a bank or insurance provider. As per Article 30 Clause 6 of the Corporate Tax Law, natural persons, banks, and insurance companies are exempt from the interest cap together with any other taxable person as determined by the Minister. Therefore, Article 12 Clause 5 of Ministerial Decision No. 126 of 2023 states, if a member of a tax group is a bank or insurance provider, then their income and expenditure is disregarded when calculating the total net interest expenditure and EBITDA of the tax group for the purposes of the General Interest Deduction Limitation Rule. This ends our video session. Subscribe to our channel, and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA-approved UAE corporate tax qualification. His contact details are provided here. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more detail. FinExcel. We create value that matters.